Welcome back, everyone, to our latest installment in the Introduction to Banking. And we have now started last week to discuss credit management, credit and loan business, lending business of banks. Here, again, to get everyone up to speed, we're talking about the microeconomic business and practical part of banking. I cannot stress enough the importance of all of this to financial economics. If you ever see someone talking about banking, it's usually because it's financial economics. And the stream of thought is usually this. We want firms to invest. We want firms to hire people. How can they do it? They need investment. How do they finance investment? They need bank loans. So you need banks. Banking, lending, economic growth. And if you have no banks, you have no lending, you have less investment, and you get an economy with virtually no growth. That's why banking is so important. That is why we care what the ECB is doing. That's why we have financial economics talking about crises, lending, monetary policy, and so on. So this is actually one of probably the most important part in banking. Here in this lecture, because it's not a class on financial economics or financial intermediation, we are talking about the practical issues that are connected to lending. But keep in mind that lending usually is very, very important, and basically all, for example, the European Central Bank cares about right now. They want to stimulate more lending, they want to stimulate more investment, and it's not working. But anyways, collateral securities and collateral assets and collateral clauses in lending contracts are very important, obviously in firm loans. Not so much in retail loans and mortgage loans, but it is very important in firm loans. And this is what most of the banks do and what they are looking for. Loans to banks. We've talked about the different types of assignments. I gave you this disclaimer that most of the translations are a little bit suboptimal, I would say. This is simply due to the fact that they are all translated from German law system. So we have the Mantelzession, Globalzession, overall assignment, blanket assignment, and we shortly talked about the difference between the two. It is a minor difference, and it refers to and is related to the question, when is the actual claim transferred to a new contract party? Is it only transferred, is the claim transferred at a certain point in time when we transfer a list of claims, or is it transferred as soon as the claim comes into existence? That's the main difference. And the difference here is that you give a list to the party you want to transfer your claims onto, and the second type is where you have a blanket assignment, where actually you sign over all those claims against persons, for example, or companies starting from A to H, A to maybe K, and as soon as you have a claim, it is already transferred to the third party. That's the difference. This is done frequently in credit risk management and in some other cases where you, for example, have claims from, let's say, trading or from retail business, and where the company doesn't want to care about credit risk management. If they frequently have claims against their customers, but they don't want to care about credit risk management, they simply do a blanket assignment to a company that is specialized on dealing with probably default risky customers, and then all those claims are transferred. And what is the benefit for the company that takes over those claims? Now, assume, for example, let's make an example. Let's assume, well, I'm a bank. I give out loans, and I immediately sign over those claims, those loans, to a third party. Because, for example, I give out loans, but I don't want to deal and I don't want to manage those loans, for example, in the subprime segment. What do I have to accept? Why would anyone buy those loans from me directly if I've given out the loans? How could this work as a business model? Very simple. The bank gives out the loans. Those loans have a value. At least on average, you can calculate the average value of those loans in the portfolio, and they will sign over the portfolio to a company that is specialized to deal with those subprime mortgages, for example. And what does the bank what does it have to accept for that? A haircut. Let's assume that, for example, you give out $100 as a loan. You would expect a net present value of this loan to be like 125 because you get interest payment. Then maybe you would say that, okay, on average, I will accept a haircut of, say, 10% of the net present value. So 100 is the nominal amount. The net present value is 125. I accept a haircut of 10%. So I would get what? 125 times 90%. That would be the price I get from my third party who is buying those loans. And then on average, I would hope that I'm fairly good off. I'm well off. That could be a business model. Giving out loans, but selling them off to a service company that takes over credit risk management. Im Deutsch sage ich das einfach mal kurz, das gleiche Modell haben Sie überall da, wo Sie letztlich Forderungen sofort an die Inkasso-Unternehmen abtreten. Auch da ist das häufig so, dass die ganzen Forderungen einfach über eine Global- oder eine Mantelzession einfach weitergeschoben werden an ein Inkassobüro und das kümmert sich um das Eintreiben der Gelder und das Unternehmen, das die Forderung eigentlich hat, ist dann aus dem Schneider. Nur Sie müssen da natürlich einen Abschlag für akzeptieren, weil das Inkassobüro macht das ja auch nicht umsonst. Okay. That's one type of collateral. We also have Sicherheitsabtretung, Transfer for Security, Constructive Possession, Besitzkonstitut. Those are just variants of this. And the question is whether the company that originally owns the asset is allowed to keep it and to use it. Can you give me an example of an asset which you want to use and you want to continue to use as a company instead of just selling it off or writing it over and signing it over to another company? Best example, cars. If, for example, you own a lot of trucks, if you're a company in the logistics sector and you own a lot of trucks, it might be that you sign over the rights to your trucks to, for example, the bank, but you still want to use your trucks because otherwise you will be bankrupt. You cannot do any more business, your revenues will go down. So this is an example where, for example, you might want to consider this constructive possession, this Besitzkonstitut, where you sign over the rights to your assets as collateral, but you are still allowed to use it. Now, this is important for some companies. Right of lien is the encumbrance of an asset or right to secure a claim. The bank may utilize the impounded object for the settlement of its claims from interest payments, and the right of lien on a claim comes about by drawing up a contract between the two parties. Thereby, the debtor of the claim has to be noticed, which is why the assignment for security is preferred in practice. The difference is that in some cases, you will sign over the rights, but for example, if you sign over a claim to a loan, the person who has received the loan does not need to be notified. It doesn't get any notice of that. The right of lien is different. Then he or she has to be notified. And usually banks will try to prevent this. They don't want to inform customers, you're such a valued customer, but we are no longer willing to take your risk, so we've privately sold off your loan to another company, but still continue to do business with us. They will try to make this covertly and sign over those loans to some other investors without notifying those lenders. So this is a right of lien. Okay. Right of lien on a security. Same thing. It's just that you have a right of lien on a security, like a stock or a bond. Credit institutions often demand a right of lien on securities that they keep safe in their general terms of business. And with a right of lien on a movable object like jewelry or precious metals, the pledge is also handed over to the bank for safekeeping. In practice, all of this is very important. I have to admit, scientifically, when it comes to research, no one cares about this. I mean, it's good to know about the fine print, the details of this, but all of this is probably something you would learn in a bank apprenticeship. And I only want to mention this here because this is an introductory class on the bachelor's level, but scientifically, usually this is not studied too much in detail. This is very practical. Right over real property. I want to give you one explanation of this, and I have to use the German words, because I don't think we have this in some other legal systems. We, in Germany, we distinguish between two types of rights over real property, Immobilien. Does anyone know which ones we have? Yes? Yeah, Hypothek and Grundschuld. We distinguish between Hypothek, which is a mortgage, and Grundschuld, which is land charge. I don't know if this exists in other legal systems, but we make a fine distinction between Hypothek and Grundschuld. Does anyone know what the difference is? The Hypothek, the mortgage, in contrast, let's start with the Grundschuld, the land charge, if you can translate it that way. It's an abstract claim against real estate. What does it mean? Does anyone know which of the two is used almost all the time in Germany? Is it the Hypothek or the Grundschuld? It's almost always not the mortgage, not the Hypothek, but it's Grundschuld. Does anyone know why? If you get a mortgage loan and you agree to a Hypothek, if you agree to a mortgage, this means that the bank can use the real estate in case you do not pay your mortgage. And if you have finally paid off your mortgage, this right, this collateral vanishes. This right of the bank to use the real estate no longer exists. Die Grundschuld erlischt mit dem Abbezahlen des zugrunde liegenden Kreditgeschäfts. Hypothek. So what is a Grundschuld? What is a land charge? The difference is that it's abstract. It's based on this mortgage loan contract, but if you have paid off the mortgage, it still exists. It only is the case that the bank can no longer exercise this and use this right, but it still exists. So if you need a new mortgage, if you want to get a loan, you can use the Grundschuld and use it as a collateral in a second contract. And that is why usually banks, and you probably, will do the second one, not the mortgage, but the Grundschuld. I still remember my parents doing the same thing. Why? Because they thought that when they bought our house, they thought, okay, if we have paid back our mortgage in 20 years, it might be that we need additional money, we need an additional loan to do some repairs. So instead of doing a mortgage, getting a mortgage on the real estate, that will automatically vanish if the first loan has been paid off. Let's do the other thing. And in case we need an additional 20, 30, or 40,000 euros in 20 years, we can just use the Grundschuld from the first contract. Why? This has to always, everything with real estate in Germany has to be done with the help of a notary. Wir müssen zum Notar gehen. And the notary, the public notary, will charge a fee for doing both a mortgage or a land charge. Für die Hypothek oder die Grundschulden müssen Sie Notargebühren bezahlen. And instead of doing it all the time for each and every new contract, you only do it once. And if it's paid off, the bank can no longer use it. But you can use it and sign it over to another bank. And you don't have to change the public records. That's the advantage of land charge or Grundschuld. Also es ist ganz überwiegend so. In fast allen Fällen werden Sie immer eine Grundschuld vereinbaren, weil Sie ansonsten sich immer und immer wieder mit den Notarsgebühren beschäftigen müssen oder die zahlen müssen. Ansonsten zahlen Sie einmal eine Grundschuld und die Grundschuld, weiß das jemand, wie das dann läuft? Hatte ich gerade erst wieder praktisch. Sie gehen zur Bank und Sie sagen der Bank, Sie möchten die Grundschuld gelöscht haben. Und die Bank muss Ihnen, wenn der Kredit abbezahlt ist, die Bank muss Ihnen eine Löschungsbewilligung ausstellen. Und mit der Löschungsbewilligung können Sie zum Grundbuch gehen und es aus dem Grundbuch löschen lassen. Sie müssen es aber nicht. Hatte ich jetzt letztens tatsächlich, da musste ich die seit 10 Jahren bereits abgezahlte Grundschuld meiner Eltern musste ich löschen lassen. Und dann bin ich zur Bank gegangen und habe gesagt, hier, Löschungsbewilligung, her damit. Also das geht einfacher und deswegen, wir sprechen zwar immer von Hypothek, aber im Grunde genommen rechtlich ist es fast nie eine Hypothek. Es ist immer eine Grundschuld, die Sie vereinbaren. Okay. Loan securities can be divided into accessory and abstract. And we just saw this example. Accessory, accessorische Sicherheiten or abstract collaterals, securities, abstrakte Sicherheiten. It depends on whether your collateral or the security that is pledged as collateral is related to one specific claim or if it's an abstract one. You just heard the perfect example for this. The Hypothek, the mortgage, is an accessory security. The Grundschuld or land charge is an abstract one. It's not related to one particular loan, but it can be used in different loans. That's the difference. So surety, right of lien. Mortgages, those are accessory ones, and guarantee, assignment for security, transfer for security, land charge, those are abstract ones. Same, not just related to real estate, same thing also with the promise to pay someone's debt. It can also be accessory, that you guarantee to pay back this particular loan, or you guarantee to pay this person's debts. Could be from this loan or another loan. That's an abstract one. What else do we have? We have covenants. What are covenants? Covenants are additional contractual agreements for bank loans between, and also sometimes in bonds, between the creditor and the debtor. I will give you a very simple example. You can read through the slides and it should be immediately clear what I mean with covenant. I'm a bank, you're a business customer. You need 5 million in loans, and I will give you 5 million loan for 3%, and I will sell this loan to you under a number of covenants. First covenant is if your, first of all, you have to invest. I want to see investment at least in the amount of 3 million out of the 5 millions, otherwise I want my money back. First covenant. Second covenant is your return on assets in the next annual report for 2020 has to be at least 3%. If you report a negative return, the interest rate will increase from 3 to 5%. Second covenant. Third covenant is you are not allowed to pay managers more than, say, 500,000 in total. That's a negative covenant. So not too much executive compensation, return on assets, some balance sheet and balance sheet ratios, some financial ratios have to be at some point and at some level, and you are required to invest. And for example, you're not allowed to do any business in, say, France for some reason. I don't want my money to go to France or, say, Italy, so you're forbidden from doing something. Those are covenants. Interest rates will change, or you will be able as a bank to prematurely cancel the contract in case the company does or does not do something. And we have affirmative covenants. So the creditor agrees to perform or refrain from something. Otherwise, we can terminate the contract. Financial covenants, event risk covenants, something happens, and the interest rate change. Those are covenants, and they are meant to increase the probability of repayment or price in the additional risk that has been identified within the before the maturity of the loan. You want to make sure that credit risk is properly dealt with here. So they try to limit the dangers which can result from incomplete financial contracts, from moral hazard, and so on. Those are covenants. Some affirmative covenants. Negative pledge prevents the collateralization of future debts to the disadvantage of the creditor. Or it's a positive declaration, for example, the property owner agrees to not encumber his property otherwise or sell it off. That would also be very disturbing for me as a bank if suddenly the company gets a loan and then it tries to sell off all its assets. Gleichbehandlungserklärung, pari passu, the statement of equal treatment, means that it ensures that in case of bankruptcy, the bank's claims have at least the same priority as the claims of other creditors. That you are, as a bank, that you're not worse off than other creditors. Okay. Cross-default clause allows the creditor, the bank, to terminate the credit loan when the economic situation of a company that has a cross-guarantee system together with a debtor is impaired, meaning that someone else defaults and you can terminate the contract with this particular company because you know the other default of the other company will have an impact on this company as well. Best example in the car manufacturing and automobile industry, if you know, for example, if Daimler defaults, all those suppliers to Daimler will also be in big problems. And then banks may terminate their loans prematurely. So those are affirmative covenants. Owner maintenance clause allows the creditor to interfere at a change of ownership of the company taking out the loan. Disposal of assets clause, creditor can prevent or control the sale of assets. Dividend restriction clause, you are not allowed to pay out very high dividends. Also quite clear why we're doing this. Key figures in financial covenants. Financial covenants are always related to financial ratios. You need at least an equity ratio that is this high. You need a return on assets that is this high, or return on investment. You need a minimum cash flow, and otherwise you may terminate the contract or you can charge a higher interest rate. Very intuitive. So that's collaterals, and those are covenants. Very, very important in business loans, in business lending. Not so important in retail loans, because if you take on a loan of, say, 5,000 euros with your local savings and loan association, no one cares. You don't have a return on equity, you don't invest, you don't have any annual report, and you certainly, most of the time, don't have any assets. So there will be no covenants, there will be no collateral. But in business lending, if you lend money to firms, you will look for covenants and you will look for collaterals. What you also do is, any idea what you do if you give out large loans to companies? If, for example, Daimler or BMW ask for 200 million euros as a loan, what would you most of the time do? If you are a bank, such a loan would be very risky. What would you do if this is too risky for you? And there is a phrase for that is used all of the time. You syndicate the loan. What is a syndicated loan? This is nothing shady. This is not a drug syndicate. It's a syndicate of banks. And actually this is quite legal, even though the name suggests otherwise. What is a syndicated loan? In a syndicated loan, many banks pool together and they combine their efforts to give out a large loan. So if, for example, a 100 million euro loan to Daimler or BMW is too large for most banks, they will look for a syndicate of loans and they will put up a team of banks, a syndicate of banks, just for this particular loan. And this loan will be called a syndicated loan because it's given out by, say, Deutsche Bank, Commerzbank, and Bank of America. So these three banks, they pool together, and it might be that, for example, Bank of America gives 50 million, Deutsche Bank gives 30, Commerzbank gives 20, so they have different roles in this loan. And to be honest, I don't know too much about syndicated loans. It's important. It's very important for banks that are in big business and big lending and corporate lending. And you have different roles of the different banks. And you can study this in detail and see how they give out loans, what different, how their roles work, and what the effects are of these different roles in a syndicated loan, and how the syndicated loan market works over time. Right now there are a couple of papers out. I think the most recent one is again by a colleague called Sascha Steffen at Frankfurt School. He has studied the syndicated loan market in a couple of papers, and I think his latest one is on the effect of Brexit on the syndicated loan market in the European Union. Quite interesting. So if you're interested in this, just go to the internet and check out the papers in the research done on syndicated loan market. Now these are securities, collaterals, covenants. Let's work through those different types of loans. We have already talked about this. We distinguish between retail loans to private customers, retail customers, and to corporate and sovereign clients. And we distinguish between short-term and medium and long-term. Short is everything up to 1 year. Medium is one between 5 years, and long-term is 5 up to 30 years. Retail customers, that's very simple. Overdraft credit, securities loan, credit card credit, or you get a consumer credit, a Realdarlehen, difficult to translate that, or a building society loan, and Bauspardarlehen, also very German. Corporate customers, on the other hand, they will get an operating loan, a bridging loan, discount credit, Lombard loan, guarantee loan, acceptance loan, investment loan, Realkredit, Euro credit loan, promissory note loan, Kommunalkredit, a communal loan, which is very special. That's a loan given out to a municipality, for example, to a city or a county. Banks always, of course, also finance municipalities, but it's very different from usual lending because municipalities, at least in Germany, are risk-free. They cannot default. They differ when it comes to the types of securities and collaterals used. And you start out with operating loans. Those are used for financing operations. For example, raw materials, consumables, supplies, and other operating expenses. In other words, those are the loans that are needed to keep operations running. Might be a good reason, might be a bad reason. For example, if you have additional revenues coming in, if you have new contracts, you might need more raw materials, or if your business is doing badly, you might also need an operating loan. So they're usually repaid by the generated revenues. Additional contracts, additional business, you need more raw materials, and you pay back the operating loan from the revenues generated, for example, from the new business. Bridging or intermediate loans, they serve to overcome short-term liquidity shortages, triggered, for example, by advance payments for large orders or uninsured fire damage or anything else. Again, it can be a good reason or a bad reason behind that. It could be that you're bankrupt, that you have very bad treasury management, and you're just in need of short-term liquidity because otherwise you're facing bankruptcy. Could be also a good reason, because if you're short on liquidity because your business is booming, then you might this bridging, Überbrückungskredit, this bridging credit, bridging loan. Discount credit, discount loan. Companies offer customers to exchange their claims against other parties for discount credits. Discount credit. Short-term money lending to corporate and sovereign clients. Lombard loans, a fixed loan amount is provided in sum and secured by pledging movable assets and rights. Also ein gesicherter Lombard-Kredit. In practice, you also have overdrafts and lines of credit, Kreditlinien, to which marketable securities serve as collateral in order to avoid selling them for improving liquidity. Also frequently done, you're granted a credit line by a bank, and you can use the credit line, and in some cases you need to pledge collateral against this overdraft line or credit line, meaning that, for example, you pledge securities or any other type of movable and liquid asset against this right. Very special type here, Effekten Lombard-Kredit. Read through it. I don't put too much emphasis on this here. Guarantee credit and guarantee loan. Bank takes over either a surety or guarantee for the obligations of the customer against a commission, meaning you get a fee as a bank and you accept the risk that you have to pay up for the debt of this company. Akzeptkredit, acceptance credit, acceptance loan. Bank accepts a bill drawn from the customer on the bank for which payment it bears liability against commission. Also, again, very practical. Let's not go into too much detail here. Long term, it's almost always Investitionskredite, investment loan. Investment loan is a mid to long-term loan for the company to invest. For example, to buy a new plant, to buy new machines, then it's a long-term investment loan. Real credits, real loans are used to finance building projects, to finance real estate. Euro credits are Euro-Kredite, Euro-Darlehen, are large sum loans written in euros. So if you, for example, need 300 million euros, then this is not an investment loan, this is a euro, an Euro-Darlehen. Okay. Common currencies are US dollars, yen, euro. Promissory note loans were often granted against issuing a promissory note, not marketable. Read through them. It's not too relevant for the exam. Communal municipal loans is clear, Kommunalkredite. Those are the loans given out to municipalities like cities and counties. Okay. Special types of loans. Factoring. As you know, factoring is a type of financing, actually. It's a type of financing. Why? The buyer or the factor takes over certain services such as receivables, accounting, collecting, and dunning. And the buyer bears the default risk for a fee. Also the same with leasing. At the very start of the lecture, we saw that factoring and leasing companies under German law are also considered to be financial institutions, not Kreditinstitute, but they're financial companies. And they also fall under the supervision of BaFin. And here again, yes, factoring and leasing, those are financial services. And yes, they are close to giving out a loan. That's why they're considered to be worthy of financial supervision. And factoring and leasing. Credit card loans, current account, overdraft facilities, effect and Lombard credit, securities lending, all of this are different types of loans that are given out by banks, and read through them, try to remember it, but it's not too relevant for the exam. Same with real estate loans, building savings loans, Bauspardarlehen, that's also a type of loan. Consumer loans. Consumer loans are those we also sometimes refer to just as retail loans. Small loans given out to retail customers, in many cases with no security or no collateral. And this is quite common for some banks. Retail banks focus exclusively on those types of loans, and they try to to earn a profit from managing credit risk at the portfolio level. Okay. And last but not least, I want to talk a little bit about loan securitization. Loan securitization. Well, let's start at a very basic problem in banking. Banks are opaque. Banks are not transparent. And what is meant by this? We have asymmetric information going from the bank to its creditors and to its lenders. What does it mean? In many cases, the bank has additional information, and it has more information than other market participants. And I cannot fully explain the gravity and the importance of the asymmetric information we have in banking. Why? First of all, here we have this problem that the bank knows more about its creditors, about its lenders, than any other investor. Practical example, I'm a bank. I've given out a loan to you, for example. I have access to your balance sheet, to your annual report. I know what type of business you're doing. And in many cases, this is actually done in corporate lending. If I'm a bank, if I'm the key account manager, and you're a client, you have taken out a loan, I frequently drive to your plant and I see what is happening. If I see a lot of trucks going in, going out, I know, well, business is booming. If I see that you've closed down your plant, maybe I think about terminating the contract. So I have information about you. If I were now to sell my loan given out to you, for example, to you, I can tell you a lot. But you have to trust me, you have to trust the information I give you, the bank gives you as an investor, to value this loan. And if I tell you this is a great loan, it pays a huge interest, and there's virtually no credit risk, what you would have to do is what? You would have to do the very same due diligence I've done before, and in effect, you would have to do what? You have to do my banking business. We've seen in the diamond model and in some other theoretical models you can see actually banks exist. Why? Because they act as delegated monitors and delegated risk managers. They do monitoring and risk management for you. If you're a depositor, for example. Now, if you want to buy a loan, you're in the same position. You are investing in the bank. And if you're not willing to become a bank, then you have to trust my information. If you know you cannot trust the information, what you do? Well, you apply a haircut. If I tell you the net worth, the NPV, the net present value of this loan is 100, you will simply say, well, that might be the case. I'm only paying 80. I am applying a 20% haircut to this loan because I simply cannot trust you. So I, as a bank, would then perhaps say, well, I'm not selling you this loan below par, subpar, because it's worth 100. So the bank is stuck with a loan. It cannot sell it off. That's the incentive problem we have here with simply buying or selling loans. I will show you how it is done in practice. However, I want to give you something that is to show you, I mean, you're at the bachelor's level, but you're at a university, you should be confronted with research. Now, the depositor has the same problem, right? You invest in the bank, you bring your money to the bank, and you expect the bank to invest it wisely. Do you think the bank is using all of your deposits, the respective banks? Do you think your bank is using your deposits in a wise way? Have you ever cared about this? Have you ever thought about which loans your bank has given out with your deposits? Probably not. So this is another problem. If you were just another institutional investor, if you were to buy bonds of a bank, for example, if you're BlackRock and you buy debt, if you give a loan to, say, JP Morgan, you will monitor JP Morgan, you're BlackRock. But you, as a small retail depositor, you don't have the means to monitor a bank. So this incentive problem and the asymmetric information between depositors and banks is a huge problem, has been all the time. And if you're interested in this, look at this. I found it a couple of days ago. Bank transparency and deposit flows. This is a working paper, some research done by Chen, Goldstein, Huang, Washishta. Okay. Itai Goldstein is a famous professor at the Wharton School at the University of Pennsylvania. Bank transparency and deposit flows, and it has been out May 2019, so it's freshly printed. And how much information bank depositors should have on the assets of banks is a hotly debated issue. I just told you this. On the one hand, information allows depositors to monitor banks' actions, but on the other hand, it might interfere with banks' liquidity transformation growth. Well, if you give out too much information, if you only give out, well, you stop being a depositor and you have to become a bank yourself. So then you have this problem. We provide, for the first time, empirical evidence that links transparency to deposit flows, deposit rates, banks' investment, and profitability. If you're interested in this, just go to the internet. You can find it via Google. Bank transparency and deposit flows. Fresh working paper from people who know their business, from the Wharton School. Well, look at it. Duke and Yale, some of the best advisors here in finance. Okay, so let's go back to securitization. Same problem here, just as with the depositors. You cannot trust the information from the bank, and market breaks down. The traditional problem with asymmetric information, if you cannot trust the information from the other party, the market breaks down and you don't have a contract. Now, you want to sell a loan. The borrower's creditworthiness would have to be checked again and again. So what you do is, you can try to do a classic loan sale. Under German law, simply Forderungsabtretung. Ja, Sie können eine Forderung ja abtreten an irgendjemanden. Two problems. First problem is that in this case, if you sign over, if you sell one loan, the creditworthiness has to be checked again, and you have to do it all the time for each and every loan. Very complicated. And the problem is, you need a lot of legal contracts to sign over, just say, 100 loans. You need 100 contracts. So what you do is, to make it short, you securitize loans. What you do is the following. I'm a bank. I'm Commerzbank right now. I have 20,000 loans given out, and I want to sell those loans. Why would I sell those loans? I've given them out. I wanted to invest in these loans. Could anyone give me a couple of reasons, maybe some reasons why I'm interested in selling those loans again? Ich bin eine Bank. Warum will ich Forderungen abtreten? Warum will ich die verkaufen? Ich habe die Kredite ja selber vergeben. Also habe ich ja irgendwie gedacht, das sind doch gute Kredite. Warum will ich die verkaufen? Ja? Marktlage hat sich verändert. Market environment has changed. Could be. Simplest reason, I'm in dire need of cash. I need to sell it as part of a fire sale. I need cash, I need liquidity, I have to sell off some assets, so I will sell some loans. Second reason, if those loans, if the default risk of those loans has deteriorated, I might want to sell it off now because they're completely worthless. So I might get a good price now, and the risk has increased, and I might want to sell it. Or it could be that at some point I realized that, okay, I gave out these loans, I gave these loans 2 years ago, but now my portfolio has changed, and they no longer fit into my portfolio, into my risk profile. So I'm selling off some assets now, some loans, to make my portfolio whole again. How would I do this? Does anyone know how you do this type of securitization? The traditional way it's done, especially before the financial crisis. First of all, securitization means what? This is convenient in the English language. In the English language, securitization simply means turning something, a claim, into a security, a marketable security. In German, the word is different. The German word for securitization is Verbriefung, eine Forderung verbriefen. Im Deutschen können wir das eben nicht sagen, in die Wertpapierform stanzen, ja, oder Wertpapierform bringen. Wir sagen dazu verbriefen. Wir machen aus einer Forderung einen Brief. In English, securitization simply means turning something, a claim, into a security. And that's what we do. So how is it done? I'm, again, Commerzbank. I want to sell 1,000 loans. I select those loans. This is a portfolio. And what I do is I form a new shell company. A shell company which we call special purpose vehicle. In other words, it's a post box on the Cayman Islands. It's ein also Special Purpose Vehicle ist nichts anderes als eine Briefkastenfirma in der Steueroase. It's a PO box in a tax haven state, and it's a special purpose vehicle. Special purpose vehicle is just a euphemism for the fact that it's a shell company that's only founded for this particular purpose. So we form a special purpose vehicle. They're on the Cayman Islands, Channel Islands, Bermuda, and this shell company belongs to us. It's a shell company of Commerzbank, and Commerzbank sells the 1,000 loans to this special purpose vehicle. So on the asset side of the special purpose vehicle, you will have, for example, 50 million euros in assets in loans. Now the special purpose vehicle needs to pay for this. It needs to pay the 50 million euros to Commerzbank. So what does it do? It issues corporate bonds. It issues corporate bonds, Unternehmensanleihen, and these corporate bonds will, for example, just be one type of bond, but it could also be that this SPV issues bonds of different seniority. Senior bonds, mezzanine bonds, and the so-called equity tranche, equity bonds. And this means that you can invest in the SPV, and if you buy the bond of the SPV, you are investing in this loan portfolio. The SPV markets its bond to institutional investors, and it finances the 50 million it pays to Commerzbank. Commerzbank will probably also issue a guarantee for the SPV, so if the SPV has too many losses, there will be a guarantee, so the losses will also go to Commerzbank. And what is done now is rating agency gives a rating for the bonds of this SPV. And for example, the senior tranche, the senior bonds will get a AAA rating, and the equity tranche will get a BBB rating maybe. And you can, as an investor, you can buy the bonds. And this is loan securitization. The resulting bonds will be called asset-backed securities or mortgage-backed securities. If those loans are paid back, the SPV gets its interest rate payments and its payments from the loans. It will pay the bond holders. if the loans default, the SPV will incur losses and the bondholders will not get back all of their money. This is mortgage-backed securities, asset-backed securities. And this is shown here. This is the construction. You have the originator, which is the asset seller, Commerzbank, selling of loans to a special purpose vehicle. We have a consortium of banks and investors. They will finance the special purpose vehicle, and rating agencies, they will rate the SPV and its bonds, and then you get a credit debt obligation, a CDO, or some different variant of this. You get a CDO, credit debt obligation, and if you know what happened during the financial crisis, banks did this. They issued CDOs. They did this with the subprime mortgage loan market. They sold off their subprime mortgage loans to special purpose vehicles. Then they created CDOs. Then they took different CDOs and created CDOs of CDOs, and so on and so on. And at some point, investors, rating agencies completely failed on this. And at some point, investors didn't really know what they actually bought. They only saw that they had bought bonds that were somehow related to big banks. Those bonds paid out a high interest, and they just bought them. And this is how the financial crisis spreads throughout the financial sector, because some banks, or most US banks, they securitized their mortgage loan portfolios, and when mortgage loans defaulted, the financial sector realized that actually everyone had bought into the segment by buying CDOs and other asset-backed and mortgage-backed securities from banks. Usually, if it's done properly, this is not bad. Every bank has the right to sell off assets, and if rating agencies do their job, and if institutional investors are aware of the risks, if you buy the equity tranche of a special purpose vehicle, you're assuming a high risk for a high return. That's okay. You can also buy a stock. That's legal. But if rating agencies fail, if banks get too greedy, and if you have financial engineering at its worst, meaning that you take those CDOs and create CDOs of CDOs of CDOs, and in the end, it's a huge portfolio with no diversification for some reason, and investors not being aware what they've actually bought, well, then the financial sector implodes. This is what is, I think, best described in the movie Big Short, when you see Steve Carell at some point being explained to by a quant how they are securitizing over and over again the same portfolios, with investors having no clue what they actually buy. And this is how it should not be done. However, this was done during the financial crisis. Here, remember this. The SPV is a shell corporation that the only purpose of this company is to buy the loans, buy the assets, and originate bonds. And you can do this in a very convenient way, because you can issue senior tranche, for example, AAA, mezzanine, which is an A rating, subordinated, which is double B many times, or equity tranche, meaning that any loss will go directly into the equity tranche. In this case, and again, this is nothing shady. If, for example, you want to buy into this company, and if you want to get a higher return, and if you are willing to accept a higher risk, then this is very convenient. This only leads to the completion of the financial market. You are able to invest in different ways in the same loan portfolio, and if you know what you're doing, this is very fine. Just like, for example, you can also buy the stock or the bond of a company. With a bond, you have lower risk, but also lower return. If you buy the stock, well, you know that you're buying equity. Same thing here. That's securitization. SPV, actually, I've explained most of this here. Now, It goes like a waterfall principle. So the losses will first go to the equity tranche, and then the subordinated, mezzanine, and finally to the senior tranche. Okay. You have different roles because you still have loans and they need to be serviced. So the bank can still continue to act as a service agent that services and arranges the loans, but it doesn't bear the risk. So it will get a fee for servicing the loans. What does servicing mean? Accepting the payments, checking that payments are done in due time, making sure that if you have claims, that you contact the lender and so on, that you collect your debt. This is servicing. There is also two variants, pass-through or pay-through, in which case the interest payments and repayments of the debtors are passed on to the investors, or they are managed by the SPV in such a way that investors receive the specified and to the different tranche-related payments. This is just two variants of this asset-backed securities. There are some legal restrictions nowadays, and this is closely monitored by regulators now, because this is the one thing that was at the core of the financial crisis. Mortgage-backed securities and institutional large investors having no clue what actually went on in those securitized loan portfolios. So you have some legal requirements nowadays, and to make this sure, to make this clear, the market for securitized loans went completely berserk up until the financial crisis. It showed exponential growth. Then it was completely destroyed during the financial crisis, and nowadays we again see securitized loans. Why? Because no one dared to sell securitized loan during the financial crisis. No one was willing to buy those assets and those bonds. By the way, those are also the infamous toxic assets you might have heard from newspapers at that time. Banks are full of toxic assets. What are toxic assets? Well, those are bonds of SPVs for which no one knows what they are really worth. And if you don't know what they're actually worth, if you don't know what the return will be, no one is buying, everyone's selling, and if no one's buying, there is no market, and if something has no market under fair value accounting, its fair value is zero. So during the financial crisis, most of those assets had to be written off on the balance sheets of banks to zero. This is why Lehman Brothers, JP Morgan, and all those other banks had write-offs in the billions of dollars, and they had to sell those off, or they had to keep them on their balance sheet. And now, 10 years afterwards, you can see that obviously those bonds are not completely worthless. They were never completely worthless, but during the financial crisis, they were. Because under fair value accounting, you need to write off if there's no market, if the market value is zero. Ich sage das nochmal kurz auf Deutsch, damit das alle verstanden haben. Es war ja nur die größte Krise aller Zeiten. In der Finanzmarktkrise ist ja alles zusammengekommen. Die Banken haben vor allem die Subprime-Loans verbrieft, überall rumverkauft in der ganzen Welt, meistens über ganz normale Strukturen, aber teilweise eben auch über so dubiose Sachen, dass da CDOs von CDOs verbrieft worden sind. Am Ende wussten selbst die großen Banken nicht mehr, was diese einzelnen Assets eigentlich wert sind und was dahinter steckt und wie viele Subprime-Kredite da irgendwie wirklich da drin stecken. Problem nächstes, Fair Value Accounting ist ja eine schöne Sache. Ist ja im Grunde genommen eine gute Idee, dass sie nämlich sagen, alle Vermögensgegenstände müssen auf den Fair Value abgeschrieben werden. Aber wenn etwas nicht marktfähig ist, wenn niemand bereit ist, so etwas zu kaufen, auch noch nicht mal für 1 Euro auf 100, dann ist das wertlos und dann muss es unter Fair Value Rechnungslegung, muss es auf den Fair Value abgeschrieben werden und der ist in dem Fall 0. Bedeutete, dass fast alle Banken in der Zeit plötzlich Abschreibungen über Milliarden tätigen mussten und damit pleite waren oder gerettet werden mussten. Und heutzutage, 10 Jahre später, sehen Sie natürlich, dass die Abwicklungsgesellschaften, die Nachfolgebanken oder wenn die Bank das überlebt hat, die haben diese Assets ja behalten Und die waren nie wirklich komplett 100% wertlos. Einige von den Banken und auch der Staat, der deutsche Staat, der manche von diesen Assets aufgekauft hat, die verdienen da eigentlich jetzt recht ganz gut dran, weil die natürlich jetzt 10 Jahre später auch feststellen, ja, da kommt natürlich noch einiges raus, weil es sind ja nicht alle Häuslebauer in den USA pleite gegangen. Aber diese Abschreibungen damals, die waren schon für viele Banken tödlich. Und das hier sind die berühmt-berüchtigsten toxischen Wertpapiere der Banken. Ja. Toxisch in dem Sinne, weil keiner genau wusste, was sie eigentlich wert sind. Und wenn das keiner weiß, muss man sie abschreiben. Okay, so that's loan securitization for you. It has a lot of advantages. First of all, it brings you liquidity when you're in need of liquidity. You can sell off loans and you can get fresh liquidity. My PhD advisor has a nice saying in German. He calls asset-backed securities das ABS-System der Bankbilanz. Ja, also das Anti-Blockiersystem der Bankbilanz, weil sie ABS comes from cars and it prevents your brakes from blocking. And he calls it the ABS system of bank balance sheet. Why? Because you get liquidity. You get unblocked because loans are long-term investments and you get short-term liquidity by using asset-backed securitization. So that's an advantage. What is also the advantage for investors? Why is it nice for investors? Because you are getting a readily available investment opportunity for a loan portfolio. You don't have to be a bank to invest in credit risk, in loans. You can simply invest in an ABS, in a mortgage-backed security, for example. And at that time, with interest rates being a little bit higher and the mortgage loan, subprime mortgage segment being quite profitable at that time still, this was a great opportunity for investors. And you don't need to be a bank, but other institutional investors can also invest in credit risk. So that's an advantage. Okay. And now, bank regulation stipulates that banks must back default risk with equity. SPVs, at least at that time, were non-banks, and they are not subject to regulation. That has been changed, but at that time, you didn't need capital to give out those loans. And they can be used to attract new group of investors, for example, money market funds that also helped a lot during the financial crisis. Money market funds were also at the very core of the financial crisis because they were heavily invested in the ABS and MBS market. And it's diversification in this pool. You have this slide with some risks, basis risk, structural risk, over-collateralization, spread account. Read through it. This is not too important, but it's more important that you understand the basic foundations of securitization. How it works with the SPV, that you set up the SPV usually in a tax haven state, because you want to, if you're doing this on purpose, you want to save taxes. You don't do this within the European Union, for example, or in some countries where you get tax discounts. And that's securitization. You probably know that this was done during the financial crisis. I've stressed this enough now. And at that time, they did this especially in the subprime mortgage loan segment, where you had FICO scores that were extremely low. And, everyone was greedy back then. Okay. Yeah. Any questions concerning business models, income sources, commercial banking? Because otherwise, let's now turn to investment banking for the last 15 minutes. Investment banking is completely different. Investment banking is, I told you at the start of this lecture, everyone knows commercial banking, lending, deposit taking. That's traditional, old school banking like it has been done for ages, thousands of years ago. Investment banking is different and is a little bit more difficult to grasp. Why? because it comprises so many very different jobs. The best way to describe investment banking is to say it's everything that is related to capital markets. That means institutional investors only. Nothing retail going on here. Institutional investors only. Usually related to securities, bonds and equity. Advising, helping customers to buy, to invest, and to finance. And this is investment banking. If a company, if a bank doesn't have an investment banking segment, but if it does, if it's not written out as investment banking, it's usually capital markets. That's true for Deutsche Bank. Deutsche Bank doesn't have Deutsche Bank investment banking. It has its capital markets segment and division. So capital markets is actually the investment banking segment or division of Deutsche Bank. And like Goldman Sachs, they're just a pure investment bank. So what do? They do research. Analysts do forecasts and they assess investments. That is research, one part of investment banking. IPOs, initial public offerings. If, for example, we have a company that wants to issue its stocks for the very first time publicly, if it wants to do an initial public offering, investment banks will help this company to perform the IPO for a fee. Mergers and acquisitions. If, for example, Daimler were to buy BMW, they would ask for investment banks to help them. Help them in what? What help do they need? What assistance? First job is to do due diligence, to make a corporate valuation. What is, if Daimler wants to buy BMW, someone has to tell Daimler what is BMW worth, how much should you pay. What else do? They assist in financing. They will assist in securing financing. They will usually not give a loan themselves, but they will look for institutional investors who are willing to finance this, and they will look for other banks who are willing to finance this. And they will set up a financing, more or less a capital structure for this deal, and again charge a fee. Remember that in many countries, commercial banking is strictly separated from investment banking, and even in those countries where you have universal banking systems, you have some regulations on how investment banks can cooperate with their own commercial bank. And this is a huge problem, especially in M&As. And usually you will prevent the investment bank from taking part in lending and giving out a loan as part of the M&A deal. They will consult and they will advise, but they will not take part in the financing itself, because then this would be a conflict. It could rise to a conflict of interest. Could be. IPOs and M&As, and trading and structuring. Trading is very simple. Some institutional investors want to buy or sell bonds or stocks. Then they again will get assistance, advisory from the investment bank, and the investment bank will try to buy or sell the stocks or bonds or securities on behalf of the company. And what is structuring, or in other words, financial engineering? What is this? Now, if you want to invest 100 now, and you want to get 2, 2, 2, and 102, if this is the desired cash flow you want, this is what? This is a coupon bond. You can go to a bond market and buy this as a coupon bond. If you need minus 100, this cash flow stream, this is the zero coupon bond. But What happens if you need this cash flow? Theoretically, you can try to duplicate this cash flow stream by buying assets on the market so that the combination of individual assets will form this cash flow stream. This is the basic form of financial engineering. Engineering means creating something new, building something new, and financial engineering is combining linear assets or simple assets in such a way that you get the desired cash flow stream you want. Now, you could do this on your own. Problem is, if it's very complicated, you have to buy this bond and this equity and this interest rate swap and so on, and you will incur transaction costs after transaction costs and transaction costs. It will be very expensive. So what do you do else? What can you do else? You do what Christian Bale does in The Big Short. You go to JP Morgan and you say, I want this, this, and this. And JP Morgan will say, okay, we can engineer this, we can structure this, and we can sell you 200 million at a premium of 3%. And then you say, okay, that's a fair deal. The investment bank will sell and buy these products tailored to the needs of the institutional investors, wholesale, at a wholesale level, and because they are buying and selling in wholesale, they can reduce transaction costs. And that's financial engineering, that's structuring, structured finance. Gleich nochmal kurz auf Deutsch. Sie sehen ja hier, Sie haben zwei sehr einfache Assets. Es sind beides Coupon-Bonds bzw. eine Coupon-Anleihe oder eine Null-Coupon-Anleihe, eine Zero-Bond. Wenn Sie jetzt zum Beispiel die dritte Zeile brauchen, also einen sehr speziellen Cashflow-Stream, warum auch immer, können Sie entweder sich das alles selber zusammenstellen, dann zahlen Sie sich dumm und dusselig an Transaktionskosten, weil Sie müssen ja dann mehrere Assets zusammenkaufen, mehrere Wertpapiere kaufen, oder aber Sie gehen einfach zu einer Investmentbank und sagen, ich will den und den Cashflow-Stream haben, kannst du mir das strukturieren? Und die Investmentbank sagt, ja klar, kann ich, für die und die Gebühr. Und dann werden Sie fast immer billiger davon kommen, als wenn Sie sich das selber antun. So, und dann kaufen Sie es bei der Investmentbank. Und die Investmentbank macht das ja nicht nur einmal, die macht das über tausende Deals. Und dann können die das so strukturieren und natürlich auch so sich diversifizieren, dass Sie am Ende eventuell gar nicht mehr groß was kaufen oder verkaufen müssen, sondern das gleicht sich alles aus. Die nutzen dann noch Derivate und dann verdienen die daran kräftig an den Gebühren. Das ist ein Bereich, das ist Structuring und Structured Trading bzw. Financial Engineering im Investment Banking. Sehr simpel, brauchen Sie aber eigentlich auch nur im Großgeschäft mit institutionellen Anlegern. Und das machen dann die Trader und die Quants im Bereich Trading und Structuring. Okay, so those are the most important parts of investment banking. So an investment banking is a financial institution that helps clients, institutional investors, with wealth management, raising capital, trading securities, and in contrast to commercial banks, financing excludes deposits. An investment bank will never raise deposits. A universal bank will raise deposits, but this is highly controversial, and an investment bank should be separated from commercial bank because highly risky investment banking should never be financed and subsidized by customer deposits. And almost all regulatory bodies will prevent this from happening. This happened during the Great Depression. Banks in the US using customer deposits to subsidize and to finance risky and risk-taking investment banking. The result was, up until then, the greatest financial crisis of the world, and the result was the Great Depression. Result was the, what does Bernie Sanders often say? Bring back Glass-Steagall, yeah? Glass-Steagall Act that separated universal banks into investment banks and commercial banks. So no deposit taking, none whatsoever. More risk, no deposits. You clearly distinguish between the buy side and the sell side. The buy side includes advising companies regarding future investments, what to buy, securitization and the sales of the created financial products to the investment bank's clients. So again, the clients are buying something. And sell side related activities, if you are selling the securities on behalf of your clients. For example, in an IPO. In an IPO, the client, the institutional company that is doing the IPO, it wants to sell its shares, so it needs the investment bank to advise it on how to sell the stocks at what price and so on. So that IPO, underwriting, marketing, that's an IPO. Research is also on the sell side. And market making, providing bid and ask quotes to keep a securities market liquid. Is everyone clear what a market maker does? On an exchange, like the German Stock Exchange, you have some market makers and designated market makers. Those are investment banks or brokers and trading houses that stand ready and have to quote a bid or have to offer a bid and ask quote. For example, if we are a stock exchange, I could be a designated market maker. And if we only have one stock, the one of BMW, I could say, for example, okay, I'm standing ready to buy at 80 and sell at 100. Now, if anyone wants to trade, I will buy at 80 and sell at 100. I will change my quotes on a regular basis, of course. But the difference, the bid-ask spread, this is my fee. I'm making a profit because I am selling low and selling high, buying low. And I have to offer those quotes. And sometimes the exchange will also pay me a fee for me being willing to act as a market maker. Why is it market making? Well, I'm making the market. If you don't want to trade, if I'm the designated market maker, I'm willing to trade. Or I have agreed to always act as a trader. But I have to check my bid-ask spread. And the bid-ask spread is my fee for standing ready to trade. Der Market Maker erklärt sich bereit, regelmäßig, also immer, einen Geld- und einen Briefkurs anzubieten und jeden Trades mitzumachen. Das erhöht die Liquidität, aber es ist natürlich so, Sie können natürlich nicht dazu gezwungen werden, hier mit Verlusten zu verkaufen, sondern Sie werden das dann dadurch regeln, dass Sie natürlich auch einen größeren Bid-Ask-Spread akzeptieren. Ein Bid-Ask-Spread von 20 ist schon enorm. Also heutzutage sehen Sie eher so Bid-Ask-Spreads von ein paar Cent, das ist also im Großhandel, nicht bei uns. Okay. And research. Analyst reports is also a part of the sell-side activities of an investment bank. Okay. Do you have any questions concerning this very first short introduction to investment banking? No questions? Okay. Then thank you very much for your attention and see you next week. Thank you.